Okay. Okay. So, what we're going to do today, I believe and understand that the training started weeks ago, and we had a couple of leaders who were taking us through the technical analysis class, and a number of areas were already handled. It came to my notice that some other areas were already handled, and I'm going to only build up from where the previous leader stopped. I'm well aware that if I may share my screen and share my screen. Okay. You guys see my screen? So in the build-up of our technical analysis class, I hope and believe that yes, okay. I hope and believe that we looked at, let me just open this, and, go. Mm. All right. So in the build-up of our technical analysis class, I believe a background was shared, which is very true. We looked at basically uh, the introduction to market analysis, where briefly we looked at the different types of market analysis that we have in the space. You know, when you talk about technical analysis is not the only type of analysis you need to have knowledge on or skills on when it comes to trading. You need to have an added, you need to also get to know about the other analysis, which I believe Coach Musa tried to build a background on that. And we have the market, we have the technical analysis itself. No, what? Just a moment, guys. These kids are disturbing me. Sorry, guys. All right. So we have the different types of market analysis. We have, of course, the fundamental, which we all know currently, the fundamental. We have the sentiment, and then we have now what we are so fond of, which is the sorry, guys. I think is my network okay? Where I'm currently seated, is the network clear? Is it okay? Because I think that was another setback from the network.
Yeah, we can hear you.
Yeah, sorry for that break. Please let me know in case I'm breaking, because the network is kind of shaky here. So let me know so that I really don't speak to myself. Okay. All right. So let me share my screen again. Okay. Yeah, so I don't I was only trying to remind us of the different types of analysis where we have the fundamental, the sentimental, and then the technical analysis. Now, when you come to the technical analysis, which is our center of focus, diving deeper into specifically of the different cryptocurrencies that we're going to be, engaging ourselves in trading. Okay, we dive especially deep into looking at traders' behavior. Okay, the traders' behavior in the market and what we call the support tools. When you're trying to do technical analysis, the key areas that we tend to focus on or we look at to help us have a better view or understanding about what is happening in the market with regards to traders' behavior. Okay, and these support tools, some of them are already been talked about. We look at, we build up and we look at what we call the trend lines. Trend line is a key support tools used in technical analysis, what we literally know as the support and resistance. I understand the leaders there shared about in the previous class. Then we have what we call the chart patterns. The chart patterns. Now, with the chart patterns, basically, here we tend to focus on certain formations or specific formation on price charts. Okay, that we believe, or that are believed to predict future price movements. Okay.
Leader, your voice is breaking.
There are specific formations, specific chart patterns that are formed on the chart that tends to help us build
Hello, Coach Musa.
knowledge with regards to what
Hello,
is
Coach Musa.
most likely.
Okay, he left, so let's wait for him to rejoin again. Brother Ima, please, I've made you host. When Coach Musa returns, please make him host again. Thank you. Bye.
All right.
Coach Musa is back.
I don't know. This network does not want us to learn or what? I don't know why. Why it always still breaking? I gotta fix this. I could. It's very clear. It's not. You know, the network is clear. Very very clear. Am I audible?
Yes, please. You are audible.
Please do let me know if I'm audible. I think I need to. Maybe I need to. It's time I need to begin thinking of. Because now it's not good. It's not nice, really. Very unfortunate. Because I hate what interrupts a class because so bad. So bad. Very bad. Okay, let me try this one more time. I hope it works out now. I hope it works out without any problem. Hope it works out without problem. Is it clear? Am I okay now?
Yeah, okay.
All right. So talking about the support tools, the technical analysis support. As I said, we have the trend lines. The trend line is one key area that we tend to tends to aid in our technical analysis journey. And then we have what we call the chart patterns, which I already talked about, that we have the chart pattern. There are certain formations on the chart that will help us have an understanding about what is most likely going to happen in the future with regards to the market. Then we have the candlestick patterns, okay? I believe Leader More Pure also looked at this in details. We have, these are like specific candle formations on the chart that most traders tend to use to predict future direction of price movements. Now, we have this basically. You may not use all the different aiding tools. What we tend to share here is just to help you look for which one would work better for you, and then you actually improve your knowledge in. We have different schools of traders who actually pick a specific strategy of market analysis and they stick to it, and then they try to, enrich their knowledge and, knowledge in it so that they become more perfect in it. Okay, so these are just areas that different schools of traders use. Okay, there are those that specifically have mastered the art of using the trend line to analyze the market, and it works for them. Okay, the support and resistance, when it comes to that, they're able to just look at the chart and then boom, they're able to tell what is most likely going to happen next, just by virtue of building up on the support and resistance. So, and then there are schools of traders that specifically actually have mastered the art of chart patterns. Okay, they know how to, to have an imagination of what is going to happen based on the patterns that is being formed in the chart. We talked about the W shape, the head and shoulder, the triangle. Like there are formations in the chart. If you dive deep, you're going to see and realize that the formations in the chart that a number of traders have actually mastered to use them. So when they see it, a falling edge, rising edge, when they see it, they are able to tell, you know, based on what has already formed, this is the most likely possibility of what is going to happen. All right. Then we have also schools of traders that have actually so much mastered the art of the candlestick patterns. You know, the candlestick patterns, you know, the different types of candles. Leader Mopiwa told you, which is very true, that some of these candles, once they are formed on the chart, they don't just form in vain. You're not just supposed to look at them and then develop or derive no meaning from them. Each of the candlesticks you see on the chart, which is, you are aware now, is a representation of a trading session or behaviors of traders within a particular time frame or trading session. When you see a particular candle formed on the chart, you don't need to just look at it and then plainly without having a critical thinking or having a deeper dive into what actually it is trying to tell you. The interpretation of the candlestick is key, is very key in your analysis. Okay, so we have the different types. We have different types of candles, which Leader Mopiwa talked about. We have the dragonfly, we have the hammer, we have the haramis, we have a number of them, the dojis. All those candles, once you see them, they should make some meaning. You should derive some meaning from them, okay? Because once they are formed at particular parts of the market or on the chart, there is something they try to signify. So you have to borrow something from it and make meaning out of it, okay, in predicting what is most likely going to happen. Then we have groups of traders that have actually basically use what we call the technical indicators. Indicator is another support tool that aids so much in market analysis. There are those that may not be so much in good at drawing trend lines. There are those that the traders who may not be so much, so conversant with interpreting candlesticks, yeah, or candlestick patterns, and also chart patterns. But when it comes to indicators, they have actually mastered how those specific indicators, loading the indicator on the chart and looking at it, they are able to tell what is happening in the market, what is most likely going to happen in the market next. So they're able to take position accordingly, right? So those schools of traders are also there. Now, the last one, which not so many people use, is what we call chically, is actually key and equally very important in market analysis. Now, here, basically, what traders would do, the traders that are so determined to analyzing what is happening in the market with regards to the changes in the trading volume of a particular coin they would like to trade. So much of news nowadays talk about volume increasing, volume decreasing, volume. Now, the volume aspect helps you to understand the flow of liquidity, how traders are flooding or moving, money from a particular asset and then transferring it to another asset, okay? Or how different traders or investors are actually trying to bring in money from different sources and actually putting it on a particular coin. So if you see a trading volume increasing, it's a positive sign. If you see it decreasing, it literally means that people are trying to shift their attention from trading that particular asset into another. So you will be seeing that as the volume is reducing, that means money is being removed, okay, and being transferred to another asset. So basically, the monitoring of the trading volume is actually equally very critical. That's when you go to trading applications like Binance, okay, or the trading analytical tools or applications like like TradingView, they tend to give you the volume, the 24-hour volume. It helps in it should derive some meaning from it. Okay, so out of the different or the 5 support tools in technical analysis, you may not exhaust all of them. You may not be good at all of them, but out of the 5, pick minimum of 3. Let's pick some 3. Increase your knowledge in it. Try to make it part of your trading journey. Let it be part of you in your analysis. When you're doing analysis, try to look at least the key the 3 key things. If it is communicating a similar language or the same language, then it helps in actually increasing your confidence with regards to the action you would like to take in the market. Okay? Now, having said all that, particularly for me, the areas I'm going to handle is the technical indicators. All right? We are going to specifically handle the technical indicators. So are we still okay? Are we still following? Are we still okay after that point? Please let me know if we are still okay. I hope I'm not breaking this time. I hope I'm loud and clear. I hope with that background, we are able to push to the next area. Now, I'm going to handle the technical indicators, or what we call the trading indicators. Now, this is an area that most people, I wouldn't call them lazy, but most people tend to so much love using the indicators because it's more simpler, you know. It makes it it simplifies things. It reduces those technicalities because most of these indicators have those parameters already automatically embedded in them, and it's just a matter of you either customizing it or even using it in its default settings, and it will still help you get some meaning onto what is happening with regards to what is happening in the market. So it's good. Now, let's talk about the trading indicators. Trading indicators. Now, this is where most people tend to. I particularly also love trading indicators. Now, what are these trading indicators? Now, we have different categories of trading indicators. First of all, okay, we have different categories of trading indicators. We have what we call they're called trend indicators. Trend indicators. Now, trend indicators, just like from the word trend, they basically help in showing the direction and strength of price movement. We know we have the different types of trend or direction that the market tends to take. We have an uptrend, we have a downtrend, then we have the sideways market. Now, what the trend indicators help you do is that it helps in showing you the direction of the market. It can also help you track through the through the movement of the prices, the direction that the market took previously. All right. So those are, and there are a couple of them, there are a number of them, a number of these indicators. An example of a trend indicator being the MACD. The MACD, which is also one of the indicators. We're not going to look at all the indicators, but I'm going to pick some of the few indicators that I feel may be really important for you to incorporate as part of the indicators you can use while making analysis. So there are very many, but I'm going to pick a few and I will share more details on them. So we have the MACD being a key example of the trading indicator, a trend indicator. MACD simply means moving average, convergence, divergence. So we shall look at this in detail when it comes to it. And then another common example of a trend indicator is what we call the moving average. Now we have different types of moving averages. There's moving average, there is moving average exponential, but at the end of it all, what is most important is what it helps you do in the market is it helps you predict. It helps you have an insight with regards to the direction of the market. Okay, so an MA is a key example. We also have a Stochastic RSI. It's also a trend indicator, a very good one, and it's one of my favorite with regards to trend indicator. I love using it. So it's an example of a trend indicator. Now, and a couple of others, but these are the key that if at all I get a chance, I may talk more about them. Then we have also what we call the momentum indicators. Momentum indicators basically helps in measuring the speed and strength of price movement. And literally what it helps you do is it helps you determine how strong buyers and sellers are in the market. Okay? So, and a key example of momentum indicators that we may also have a chance to share about is we have the RSI. Okay, is also is a key example and of a trend indicator, and I think I will try to see how I can look at that in details. But it's very important. It helps in it helps in measuring the speed and strength of price movement, and yeah, so it's very important. Then we have the other category of indicators that we call the volatility indicators. Now, with the volatility indicators, basically what it helps you do is that it shows you how much and how fast this price is fluctuating. Okay, it shows you how fast and how much and how fast these prices are actually fluctuating or changing. And a key example under that, the volatility indicator is this one here, the BB, and I'm gonna talk about it, the Bollinger Band, and there is how it helps in measuring how how much and how fast the price is fluctuating. There is a way it behaves, okay, that once you see a particular shape in the formation of the Bollinger Band, it should help you, it should derive a meaning from it that this is what is actually happening in the market. And once that particular shape is formed, then the most likely possibility of what is going to happen next is this shape. So it tends to form certain shapes, in its movement that actually, if you learn and, get used to it, and it makes a lot of sense. You can use it and really, it makes your trading super. Okay, so it's a key one out of the different volatility indicator. I'm going to talk specifically about the Bollinger Band, but there are others. We have the average true range indicators that some of you already know about. It was shared by some other leaders some times back. So the true range indicator is also good, but specifically for me, I will talk about the Bollinger Band. Then we have those the volume indicators. We also have those groups or categories of indicators that specifically helps in analyzing the strength of price movement based on trading volume. Okay, it shows you how the volume is increasing, how it is decreasing, and once it increases, what does it tell you? And when it is decreasing, what does it also tell you? There are a couple of them, but just a quick one. We have what we call, there is one specific one which I love, which I also, if I get a chance, I'll share about, is there's this other one called the on-balance volume. It's normally abbreviated as OBV. It's also good. It's really good, and there's a lot of information you can extract from it. And then the other category, which possibly I will say is the last, is the support and resistance indicator. Yes, support and resistance indicator. Now, with the support and resistance indicator, some traders also call it overlay indicators. But this basically tend to highlight the different levels of price action. Okay? It tends to highlight those levels where price reacts, right? Once it approaches them. Just like the name support and resistance, it basically helps in establishing, it identifies, it locates or identifies and then establishes those specific price reaction levels on the chart. Okay, very, very important, very, very good, and it's very key. It helps you to, it bases on what previously happened to predict the future. So it establishes those lines, those support and resistance, automatically based on what was already formed or based on previous price reaction. And this is very, very important. It's commonly used by most traders, but also not only being commonly used, but very important. A key example that I'm going to look at are two. There is what we call the pivot point standard. This one we know, right? The pivot point standard. Very, very important. It helps in calculating support and resistance level, you know, on the chart. So, and then we also have this other one, which we also so much know. It is called the Fibonacci retracement indicator. Yeah, it's called the Fibonacci indicator. Now, the Fib we're also going to look at. I love it as well. It's also good. It's very important. You also know how to use it. Now, the Fib indicators are categorized into two. There is the auto, and then there's the manual. The manual means you simply add it automatically. It's up to you to identify the key price reaction levels from which you would want to start from and end at, and then automatically you're going to have those lines established for you, based on your key areas of identification. So the Fib is also very important, very, very important in actually establishing support and resistance. And the beauty about the Fib is that it is this support and resistance level are established based on what we call the Fibonacci levels, the key levels. We're going to look at them in details, the Fibonacci key levels or percentages. And it's always good. It's very good. If you also learn how to use it, it's really very important for you. It will help you have a better journey in your trading. All right. So with those background on the different categories or types of indicators that are available from which you can choose and then perfect your knowledge in, I believe we are good to go, because I want to look at one indicator today, and then we shall look at the others in the course of the week. So there is one key which I'm going to start with, and then we'll see how we move. So are we good? Are we good? Are we still good up to that point? If you're good, let me see. Let me just see a one on the chat. If you're still following. If you're still following. Okay. All right. I think we're good. We can move on, right? Yeah. So I want us to, we're going to look at one indicator. And basically, what we're going to look at is, which I would want us to look at, and look at it on the chart, is, let's start with this momentum indicator. It's both momentum. Now, out of the different categories of the indicators I've mentioned, there are some other indicators that cuts across. Okay, you'll find them being momentum indicators. Some of them are volatility indicators, and at the same time also trend indicator. So you find that they cut across. Whatever is embedded in them, it helps you cover almost like three key areas in your analysis. It helps you tell the trend, helps you trend the momentum, and so it's very important. And also the volatility. So the stochastic RSI is one key indicator. RSI is one of those indicators that is a momentum indicator, but as well also it's a trend indicator, because from each you can be able to tell the direction of the market. Now, what is this stochastic RSI? Why is it very important? Now, the stochastic RSI basically helps in measuring whether an asset has been overbought or whether it has been oversold. Okay? It helps, very important, it helps you in measuring whether an asset has been overbought or oversold. All right. Yes. And then it will also help you actually it will also help you measure where the current value of that asset is in comparison to the range of a period of time. Baby, where? Okay. Okay, so sorry about that. So the stochastic RSI helps you, helps you in assessing whether an asset has been overbought and oversold. Now, I would like to go to the chart. I hope the network does not again fail because the trading view is kind of heavy. Sometimes it helps in checking the market. But let me try out again. Yeah, so when we go to the chart, I want to specifically go and look at this stochastic RSI and maybe explain it from there. So that I hope the network is not interrupted. Okay. I hope the network for the Lord. So I hope okay. Let me hello. Try to get this off. I want us to, so this is our stochastic RSI. Can you see my screen? Oh, I think you know. I think of not sharing.
No, we cannot see your screen.
Okay. Okay. All right. So the indicator we're going to look at is called the stochastic RSI, and it is here. So when you go to the list of indicator, I hope now you know how to use the trading view. So this is the indicator. It's called the stochastic RSI. This, okay, and so when you tap on the stochastic RSI and it gets loaded on the coin, on the chart, we have this. This is how it looks. This is how it appears. Okay. Now this is I've customized mine. How based on how I want it to look. But in the default settings, if I may go to the default settings, I want to just show you something. And let me reset it. Reset. Okay. All right. So when you just tap on the stochastic RSI, this is how it is going to appear. Let me increase the size. Okay. Okay. So can you see it? Is it visible? So this is how the stochastic RSI looks like. And okay. So when you oh, okay. So when you tap or when you go to the settings of the stochastic RSI, the stochastic RSI has two moving averages. First of all, there is what we call the K line and then the D line. Now, you wouldn't mind about the technical part, okay? Don't mind about the technicalities. I want to just make it easier for you to understand. That's why you see in my sharing, you shouldn't expect so much of technical terms, but rather a simplified language for you to understand. So if I call it D line and I don't use the specific terminologies, don't get worried. So we have it has two moving averages or lines that runs alongside one another. We have the K line and then the D line. Okay. Now when you come here, the K line in the default settings is in blue color. It's blue in color. Then the D line is orange in color. So let's look at it. You see it? That the K line is that, and then the D line is orange in color. Now, if you realize that these two lines tend to move together, right? They tend to run alongside one another, right? They run alongside one another. However, you might have also observed that in the process or in the course of them running alongside one another, there comes a point where the two crosses one another, okay? There comes a point where the K line crosses above the D line, like in this case, like in this scenario, okay? The K line is crossing over the D line, and thereafter, the K line begins running above the D line. Then there are also some other instances where the D line crosses below the K line, all right? I mean, it crosses below the K line. So when, above the K line, not below, but above the K line. So, and when it does that, then they begin running, whereby the D line again runs on top of the K line, like we are seeing it in this scenario. So it means therefore that the interpretation and the use of this indicator is based on the crossovers, okay? The crossover. A crossover like this and a crossover like this should be in position to communicate something for you when you see it happening in the market, okay? Now, since it is a trend indicator, at the same time, as these two lines run alongside or parallel to one another, they actually show you the direction of the market. In instances where the K line crosses below the D line, it means that the trend is a downward trend, okay? When the K line crosses below the D line, like it has happened here, it shows you that the trend is a downward trend, okay? But then in instances where the K line crosses above the D line, like it has happened here, it shows that the trend is an upward trend. So you have a crossover where the K line crosses above the D line, then we have a crossover where the D line crosses above the K line. And all of them tends to show you a shift in the direction of the market. Okay? So a crossover is actually what brings about a shift in the market, a change in the direction of market movement. Okay? Now, if you check critically that when the K line crosses and begins running above the D line, like it is happening here, this is an uptrend movement. And in scenario where the K crosses below the D line, and then it is the D line now on top, other than the K line, you realize that this is the downward movement, or it is the downtrend movement. Okay? Now, this is very key. It is very critical because at least it helps you are able to tell the direction of the market by just visually seeing the movement of the two lines, the two moving averages on the stochastic RSI. But also what is also another key here is there are ranges within which these lines move. There are range within which these lines run. They run through a specific range, and this range is from 100 and 0. So they move within the 100% range, okay? It may move from 0 to 100. Then on touching 100, it shifts, it changes direction and begins moving downwards towards 0. When it touches 0, and then it may also change, it also changes direction and begins moving towards 100. It will not go past 100, neither will it come below the 0, all right? So these two areas, these are the range within which this moving averages, what we call the K line and the D line, moves within. Now, within these two ranges, there are areas that has been demarcated that is more of like a signal to you as a trader. That helps you to actually make decisions as to whether to buy or to sell, as to whether for you to go long or take up a long position or take up a short position. There are demarcations that have been established on the indicator. Apart from the 100% range within which the market moves, the 100, the 0 and the 100% range, there are imaginary lines that have been established in the default form. These imaginary lines are 20 and 80, okay? So there is a range that is given to you as a trader which should aid in your decision making. When the two moving averages are moving, once it is moving upward or it is moving in the upward direction, once it crosses the 80% line, any movement above the 80% is a signal for something. Same applies to when it is moving downwards and it crosses below the 20% line or range. Any movement below the 20% is also a signal on something. It tells you something that is going to happen in the market. It tells you something that is most likely going to happen in the market once the two lines approaches those zones. Now, the zone above the 80%, this zone above the 80%, that is between 80 and 100, is what we call the supply what? Zone. Supply zone, also referred to as the overbought region. So that zone above the 80% line or range is called a supply zone. Or you can literally also call it an overbought region or zone. Then this area below the 20%, this zone here, below the 20%, that is between 0 and 20, is a zone called the demand zone. Demand zone. You can also call it an oversold region. An oversold region. We are interpreting our indicator, the stochastic RSI indicator. We said it has two moving averages that run alongside one another. But in the process of their movement alongside one another, there comes a point where the two cross each other. All right? And when they cross each other, it's an indication of something. Two, much as they move within a range of 100%, there are a zone that has been demarcated on the indicator. There are areas that has been demarcated on the indicator. Okay? That is a signal for you as a trader. That should help you know what is happening and what is most likely going to happen when you see the two moving averages within the zone or when it has crossed within those zones. Okay? All right? Are we still together? Are we still following? Are we still okay? Are we still following? Are we still together? We are building it up on an understanding of something that is gonna, from that at least today after the class, you should go and begin using it. Hey, you're going to say yeah. You will say, oh yeah, okay. It's something that is going to help you a great deal. All right. So thank you so much. I think we are together. Now, coming back on the stochastic RSI, we already, sorry, what is this? I hope no one is calling. Okay, that's okay. Sometimes people tend to disturb. Oh, okay. All right, so let's come back. Let's come back. So we already know. We already know. We already know that literally we have a range within which sorry guys, I have some mini students here disturbing me. Kids are always around me whenever I'm teaching. They're really so much full of kindly, but the challenge is with them is the over talk, so they interrupt the class. Okay, so are we okay? Let me see if I'm not muted. It's okay. All right. Let's come back here. So on the stochastic RSI, we said we have a range. We have the features of the stochastic RSI. We have the moving averages, which are categorized into K and D line. And with this one being blue in color and this one being orange, we're talking about the default setting. However, you can go ahead and customize the settings, okay? It just depends on how you want it to appear. Then we have also, we have the moving averages, then we have the zones. Okay, the zones or region, which are categorized into an oversold region and then an overbought region. Okay, then we have the lines, the range. The lines, okay? So those are the key features of the stochastic RSI, the moving averages and then the zones and then the lines that demarcates the range. Now, when you come down here, we have the lines demarcated in this format. We have 80%, we have 20%, we have 100, then we have 0. That is how the range are demarcated. Now, then we have the lines. You know, we have a movement of this nature within the range, okay? And then we have a movement like this, okay? That kind of movement with this one being the D line and then this one being the K line. Now, this is the crossovers. This is what we call the crossovers. This is the crossovers. Now, giving an interpretation to this is that when this moving averages are are moving along one another, whenever they reach into this zone, this is what we would call the overbought region, or you can call it simply a supply zone. Then this region here is what we call an oversold region or the demand zone. Now, I'm going to explain why they're called demand zones or supply zone. Now, this is how you interpret it. When the two moving averages are within the oversold region, what it literally means is that that particular asset that particular asset has been oversold, and oversold to an extent that it has become so much in supply in the market, and the price has dropped so significantly. Therefore, it is time to demand. It is time to buy it because it's more cheaper. It's very cheap. Okay? D lines are within the oversold region. It is the best moment to take action to buy. It's the best time to make entry for someone who wishes to go long or someone who is buying, taking a buy position. Be it you're a spot trader or you're a futures trader, as long as the two lines are within the oversold region, it's the best. Now, depending on the time frame, it is the best region, regardless of the time. Sorry, not depending, but regardless of the time, the time frame, it's the best zone to buy. Now, sometimes it may take a while, right? Because being a demand zone, remember the different structures in market, the market structures. There's what we call the consolidation or what we call the sideways market. Sometimes these two lines may take some time within the oversold region or the demand region simply because traders are accumulating position. So you will see it moving within the oversold region for some time before it actually takes off or leave the zone. When it takes off and leave the zone, that is the time where now the trend is really on a bullish movement. It's on a good bullish movement. You can enjoy the ride until it gets to the overbought region. But for as long as it is within here or midway here, man, enjoy the ride because the price will be heading for 100. I mean, for this zone here, for the demand, for the supply zone. All right. So this is the best time to buy. However, if the market in this region, this area, the overbought region or the supply zone, what it literally means is that that asset has been overbought. Traders have overaccumulated. They have overbought. It's now so much less in supply. The price has increased so significantly. And before you know it, traders are going to begin taking profits. They're going to begin taking profits because the price would have rose or would have actually moved up so significantly. It would have risen so significantly in that now people have accumulated good percentage of TP and they're ready to take profit. Now, if the two lines are within the overbought region or the supply zone, you got to be very careful if you're a spot trader or someone who had taken a long position because the price is gonna, the market is gonna dump, right? The price is gonna move from that region, okay, downwards. So the supply zone is a dangerous area to make entry in if you're a sports trader or if you're someone who wishes to take a long position. As long as you find the moving averages are within the supply zone, you relax. Take a chill pill and relax. In fact, go and do other things. Go and do exercise as you wait for the price to what? to come back to you. Don't chase it because it's going to trap you up there. And then as the price is dropping, as the two moving averages are moving downwards, heading for the oversold region, it's going to take a while. And if you're a spot trader, you're going to float. You're going to float for some time. Okay? But depending on the volatility of the coin, but it's a dangerous thing to buy when the moving averages are within the overbought region. Very dangerous. So let's take a dive into the chart and see. Are we okay? Are we still okay? Let's take a dive into the chart. Okay. I will come to the questions. Let's first come here. Okay. So when you let's come back here. So on this chart, What is this? Okay. Chart is failing to load. Load. Okay. The trading view was misbehaving. Let's come back. Let's come back and let's see. Okay. See if it will load. All right. A minute, guys. That's a minute. A minute. Okay. So I hope you can see my screen. So I'm going to customize our trading. I mean, we're going to customize our indicator so that we have it clear with all the different ranges very clear, and we then try to dive into the chart and see and relate. Yeah. I don't get it. Why is it misbehaving? It's failing to load. Okay, why not? All right, all right, all right. I think we're good. Okay. All right, so let's customize. I'm going to customize it with different colors. Let me see. I'm going to pick the yellow. Then I maintain that. Then we have the middle line. Let me put the middle line to be white, and I increase the opacity. Okay. Then you come to the lower band. Let me put the lower band to have this color. We have the upper band. Let me put it to be red and also increase its opacity. Okay, so as default. And we have that. Okay. So these are my lines. Okay. There we are. So I hope it is clear now. So let's check through. We have, this is my K, this is my D. This is the 80% line or range. This is the 20% range. Then this is the 50. The 50% range divides the other level. Remember, our 100 is here, so it can never move past 100. And then we have our 0 is here. Okay, 0, 100, and then 80, and then we have 50, and then 20. Now, our movement is going to be within this range. But within this range, we have the 80%, above which is overbought. This is the demand zone. This is the demand zone. The supply zone we're talking about. Sorry. This is the supply zone, also known as the overbought. Right? Now, I want us to check through and see that the price is already within this zone. And if I may ask, would this be the best to make entry? Would this time be the best to make entry when the two lines are within the overbought region? Would it be the best? Would it be the best? Because we're going to check definitely on the chart and see the significance of that. Is it the best to buy when yes, no, right? Because when you come back on the chart, let's try to see the chart. You see where the market is? Which coin is this? This is okay. Maybe index. Okay. Index is index a new coin? No. I thought, okay. That is where. Just a minute. Let me see. Index. Let me. Okay. All right. Let me just do that. I think it's just. Let me look for another coin because I think this one has just been listed and it may not really bring out. Let me look for at least one that has taken some time. Let me go for Jupiter. Jupiter coin. This one is better. This is 1 hour time frame. And good. So let's try to interpret this. Let's bring it here. So this is our stochastic RSI. We have it here. There we are. Now, like you see here, this is our overbought region, right? This area is our overbought region. And then this is our oversold region. Now, I want us to relate and see. If we pick a particular part, like in this area, or possibly just let's pick this part here. And then you try to relate it there. So what happened? From here, the market crashed to this level. And this is what was tracked through. The movement was tracked through this, the movement of the stochastic RSI here. The moving averages tracked that market price drop. It tracked it here. But if you're to measure, you may realize that this is a very significant percentage. From there to this point is about 5%. 5%. But the most important thing there is, it's not as to whether the two lines are within the overbought region. The most important thing to pay attention to is what we call the crossover. The crossover. A crossover where the K line crosses below the D line is the most dangerous crossover. Even when these two lines are not within the overbought region, the most important crossover to pay attention to is the death crossover. A crossover where the K line crosses below the D line. And then, you see, this is a crossover I'm talking about. A crossover where the K line, which is blue in color, crosses below the D line. That's the dangerous crossover. Regardless of whether it is formed within the overbought region or in the middle here. Once you see a crossover happens where the K line crosses below, it shows you that the market price is on a downward movement. Now, a downtrend movement can be a retracement or a trend reversal. Any crossover that happens in this manner, where the K line crosses below the D line, means a retracement or a reversal. But most of all, a crossover that happens above the overbought region is a reversal. A crossover that happens within here is a retracement. I don't know whether it makes sense. A crossover that happens above the overbought region is a reversal, and a crossover that happens within but below the overbought region is a retracement. Comprehended? Yeah, so it's very important for you to know that. Now, if a crossover happens within, like we are seeing here, okay, this shouldn't worry you that much, okay? It will simply mean a market correction or a retracement. But a crossover that happens when the two lines is already within the supply zone, it should clearly tell you that that coin has been overtraded, has been overbought, not traded, but overbought. And anytime soon, people are going to begin taking profit. And when they begin taking profit, the market is going to dump. And if it gets you while you are taking a long position or you had bought, you might float. And if you're taking a long position, there's a high chance that you may be liquidated. Okay? Or you may go into a deep floating loss, even if you may not be liquidated, but you will go through a very deep floating loss. Okay, so you need to pay attention to what area you will be making entry in, especially if you're using the Stochastic RSI as an aiding tool. All right, so it is very important. So when is the best time for you to make entries? The best time to make entry is when the crossover happens, when first of all the two lines are within the over. This is the best time to make entry. But the most important time to make entry is when a crossover happens. A crossover where the K line crosses over the D line. It's a buy signal. It's something that tells you that the trend is ready to begin rallying upward. So it's the best time to buy. Or when the crossover has just happened. You can make entry when the crossover is just about to happen, or when it has just happened. And which crossover? When the K line crosses above. The K line crosses above the D line. It is the best time to make entry. A key example is here. When the K line crossed above the D line, if you try to take this upward, you're going to realize that from here, you saw what happened. The price rose, and it rose significantly. Let me just use this and try to, let me pick this and bring it here and there. Okay, can you see that? So this crossover, see, this is the point where the crossover happened. Okay, it's just slightly before, anyway, maybe in this other session. Let me see. This is when it showed a sign of crossing over, but I believe you get the idea. Here, you saw, once you see the K line already bending towards already bending towards the K line. I mean the D line. This is D line, this is K. Want to see initially the movement was in this manner, and then you see a sign of the K line bending towards the D line like it is happening here. It should tell you that the trend is about to come to an end. Therefore, it is about to shift direction and begin moving upward. So it shows you a possibility of a crossover happening. Now, once you spot at that moment, please prepare yourself to make entry. Monitor it closely and make entry, because once a crossover happens, you are going to take advantage of that movement in the rise in the market price. It may not be a significant market rise, or it may be a significant market rise. The most important thing is, as long as a crossover happens, you should expect a market price rise. Okay? Just like we saw here, this is what happened from here. There was that movement to this point. And that is actually significant. If you had made entry around there, it's something. If you had made entry here, or you made entry at the candle open of the next trading session, this was around 4% in profit. All right. So if you had set your 1%, your 1.5, your 2%, you'd equally be out. You'd be good to go. Because for us, we don't trade with so much percentages. We tend to take 1, 1.5, 2. It's okay. Here you will be out, as long as you made entry at the right moment. The next example here, if you look at this point, is when the crossover happened here. When the crossover happened here and here, so here, okay? That when it happened here, this is also another thing we realize happened. You realize that the price on crossing over here, the price had to move. This was mega movement. We saw here, from here, the price moved to this point. Now, this is just more than 1%. With the strategy that we use, the compounding strategy where you only take 1%, 1% is very, very easy to achieve, as long as you follow this. Sometimes you just need to follow your principle. You need to follow your strategy. Anything that you see is contrary to what you're thinking or what you're seeing in the market, don't go for it, okay? Yeah, so this would be good, okay? This would be good. So this crossover is a good sign because the market price moved. Another crossover is here. It also resulted into a market movement. Same applies to here. So any crossover where the K line crosses above the D line is a buy signal for me. It can happen within the oversold region. It can happen within here, as long as it is not in the danger zone for the sports traders or those who intend to take a long position. This zone would be a danger zone for you. But it is a beautiful zone for those who would want to take a short position. Now, this is strictly for the futures trader. If the two lines, all the moving averages, the K and the D lines are within the supply zone, it's the best to take a short position. Okay, it's good to take a short position, right? Also, another beautiful opportunity for those who would like to take short position is when this crossover happens. When the K line crosses below the D line, it's a short signal. Take it up, right? Take it up. It's a short signal. Take it up. We saw what happened here. Boom. There was a drop in the price when this crossover happened. Let's check another. When we were here and the crossover happened where K line crossed below the D line, we saw another movement which was tracked here. This crash in the market price or drop in the market price was tracked here by the K and the D line in their movement downwards. And it was also significant. So it was a good sell signal, right? Taking short position. Now we come back here. Now let's go to where the market price is currently. Here we are. Here we are. Now, to me, this is a very beautiful buy opportunity, a very beautiful buy opportunity. Okay. Now, for why I'm saying that, because already I have in my mind, I've already incorporated around two things, or I mean 3 things at the same time. What you're seeing here is support zone. All right. And looking at how the market, how the price dropped. This is a very, very beautiful buy signal for whoever wants to take a long position or wants to buy this Jupiter coin. Look at this movement, right? This was a drop, but that drop was tracked through. The movement was monitored by the Stochastic RSI. And we entered the demand zone, which is also called the oversold region. It can't help. It cannot help it. This price won't help other than move back up. It can't help other than the K line just crossing over and moving up. And secondly, if you check through, this could be, as you see the price struggling to continue down, this should tell you that this is a consolidation zone. It's a support zone. And if you to go back in history and track through with your knowledge of support and resistance, you're going to realize that this is a key support zone. Let's try to check through and see. If you're to draw something there, you realize this is a key support zone. Let me use this. Let me try to just demarcate, put something there, and we see if it is something that is true. This is a support zone. Let's check it out. You see? You see? And if you check again, this is another, in that movement, this is this is key, very important, because if you check through this movement, the way the path was monitored, this was the price started from here, it had to move, got supported, it retraced, briefly broke structure, though it was more of like consolidating, but then finally it broke that structure, okay, to this point, it retraced and broke to this zone. Now it pulled back to this point before breaking structure. Now it means literally that it's a key, because it's a key support area that supported the retracement of this movement here. Then the next one was a break of structure here to form that movement. And there was a little retracement before it went. So the price being either around here or above this area, it means this is a key support zone. If it breaks below it, it will find another key support zone here. But within this area is already an area of consolidation, and the price will have to, under all means, obey. Here, it is struggling. It is struggling. And by the look of things, that, you know, we are already within the oversold region, and it is a demand zone with a short or a small margin call drop. We could be good to go to see a very good rally back to this zone. And by the time it arrives at that zone, this movement here would also be tracked, and we'll find ourselves around there within the overbought. Because this is very good and a very huge percentage. If you're to enter here, take your profit to this zone, but at the same time, with margin call, just establish, just in case, establish it to this zone. With a margin call of about 1.1% call drop, and then with a TP, that's a ratio of about 1 to 6. This would be very, very good. And trust me, it's a good one. But if you want to be safe, you could establish the next zone, the next support zone, and see if you can establish, if you can as well establish more or open more margin calls. So let's see. If we establish the next zone is around here. This is the next zone. And the next zone could possibly be this. This is key. And then finally, that is equally key. Just to be safe. Or to lastly, that key swing reversal level. That one. You cannot help. Just a matter of buying some time and seeing yourself back. This is under extreme condition, just in case, extremely. If it is to continue further, it will not go past the 3%. That's roughly 4% drop. So if you can establish some two margin call drop, but with the aim of taking 6% in the course of the day, this is a build up of the day. It may happen within an hour, 2 or 3 or 4, even in the course of the day. Because if at all the reverse happens, depending on what is going to happen in the course of the day, the volatility may result into just one candle alone being enough to give you candles building up as it takes you up. It can just be a single candle. We don't want to be hypothetical. We just want to be calm traders. So this is good. Is a key example of making entry based on stochastic RSI when the moving averages is in the right zone, is in the demand zone. Try it out. Trust me, take this up and see. You'll tell me in the course of the day what will happen. If it will give you or not. That is it. So are we good? Are we good there? Now, basically what I do here is not so much in-depth analysis or in-depth training. It's just giving you the basic. Okay? Yeah, you just tend to give you the basics, just to give an idea, a rough idea how you're supposed to look at the market and possibly reduce your over dependency on signals. Sometimes you just have to take it upon yourself. Go to the chart, look at how the market is, and take up trades. Okay. We are trying to eliminate, not eliminate, but reduce dependency on signal. We want you to take charge of your business. That's why we give you this basic. Okay, sorry. But literally, we have come to the end of our sharing with regards to what I hope you learned something basically about the stochastic RSI and how you can use it. And yeah, so if you're going to be, as you're going to go through the learning, you choose what you think may work for you. Okay, you will not use everything. Okay, I will share a number of these indicators, but then you can choose. And as I said, you at least have some 3 that you know you're gonna familiarize yourself with. Just get used to it. And let me tell you, because the more you use a particular indicator, the more you will understand it deeply, and the more you're going to be so fond of it that a moment you just add it on the chart, you just literally visualize whatever is most likely going to happen in the market based on what already happened, or based on the record of what has already been established. So it's very easy. The more you use something, the more you become used to it, okay? And the more you'll understand it better. Okay, so the stochastic RSI is a powerful indicator. If you use it often, you're going to realize its magic, okay? But you don't use an indicator as a standalone tool in analysis, all right? You need to incorporate 2 or 3. Have some 2 or 3 elements that will help you establish a proper area of confluence, okay? And then from there, you can make decisions. Because now we have used the stochastic RSI, we best, for example, I just gave a simple example. We brought in the aspect of support and resistance, and just in the look of things through, if you had brought in also looked at, you had tracked through that movement based on the trend. If you had drawn that trend to monitor through how the price was, moving downward, would equally find out that I think with the area we arrived at is something that could make sense, and it will give us an that confidence of making entry. But it's very important. Try to increase your knowledge in it. Okay, you can further go learn more, so that you get so much used to it. Use it often. Okay, don't just learn, but also use it. You can customize it the way you want it. You can actually also increase your demand zone from 80 and maybe only reduce it to 10, such that you have a range of 90 to 100 being for you, being the dead zone for you who likes taking long position, or you like to buy for sports traders. And then you can as well also reduce from 20 to 10, so that you have a difference of only 10 as being your demand zone. It's also equal, okay? It just depends on what you would like to do, okay? You can as well increase it. You can increase the range to, instead of 80, you can set it at 75. You have a range of 25 as a dead zone for you that you cannot trade in. And then you also have a range of 25, which is the safest zone for you to really make entry and buy or take long position. You just go about customizing them. And then the more you customize it, the more you use it, the more you frequently base on it to make analysis, the better it will be for you, okay? Yeah, so basically that is what I'd prepared for us today. I hope it was helpful, and I hope to see you tomorrow as we look at another indicator. And hopefully by the time we are ending this indicator things, we may try to bring in an aspect of how you can incorporate at least 2 or 3, analytical tools, maybe 2 indicators, and then adding in some other technical element or price action element to see how you can make a perfect or generate a perfect signal, or identify a perfect entry opportunity for you who would like to make entry in the market. So thank you so much for being here. It was a privilege having you all, and over to the leaders on the call, if there is a word or 2 that they may like to share, possibly. I don't know whether I have any question, because as I was off, when you get out, the questions also tend to delete themselves. You won't see the questions that were previously shared on the chat. So I don't know if there were some that I don't know, because I only see from we can't hear your voice and downward. So the others, I am unable to see them. I don't know if there's any question there. Yeah. Okay. All right. So I think that's basically all, Leader Doris. I think you there, Leader Piwa, Emmanuel. I think over to you guys, if there's anyone.
Thank you so much, Coach Musa. We really appreciate the knowledge you've imparted into us. So guys, we would meet again in some few minutes time for the normal meeting. Okay, I think today is about trade settings. So the links will be shared as usual. And yeah, so that is all for now. Thank you so much for joining in. Really appreciate. Have a nice day. Bye.
All right. Have a good day. All right. Bye.
Thank you.
You're welcome.